I see people have successes in trading, I'm always happy for you, but I'm hoping it's not short-lived. Are you the problem or is your system the problem? So AI is good. Trading is a casino, but it's your choice whether you're the house or whether you're the person coming in.
Unlock money power.
So you're trading every day?
Yes.
Oh my gosh. Because I heard that some of hedge funds, they're not trading every day. They're just doing it once a month, 1 in 3 months, or they holding position for a long time.
Correct.
Is that true, or it depends on the strategy?
It's true. So it all depends on what the fund mandate is. So some are active funds, which is where they have to be active within the fund. Some are portfolio driven, so they just build a portfolio and they just wait it out. So it would be 1 year, 2 year, 3 years. They might not need to do anything. The only thing you'll find is they go through a rebalancing process, which is depending on the mandate, once a quarter, once a year. And essentially, if you buy 40% of one stock and 6% of another stock, one goes up more than the other, then at the end of a quarter, you just make sure that you rebalance it. So you still have 40% in one, 6% in the other. So that's pretty much what some of the funds will do.
So that is true that you're only managing the risks.
You definitely will need to manage the downside depending on how the portfolio is structured. So if you're actively trading it like what we do, we would have a mandate of the volatility, which is the maximum it can go down, let's say. And yes, with that, we'll do daily risk management on that. For other funds, if it's a long only ETF type SPY, they just hold it out. They'll just wait for the drawdowns to happen, 30, 40%. They'll just wait it out for it to come back to the new high.
So we can say that it depends from the instrument that you are trading?
Correct. It depends on the instruments. It depends on the methodology that you're using to get that alpha for your clients.
I got it. But do your clients have an access to the portfolio, or they just know what you're trading basically, and they don't know all the details? They just receive their returns. Yeah.
So my clients just get the returns. They know we trade stocks, options, the equities markets, and also the futures market. So we're an active fund. So we're in and out, usually monthly or quarterly. We're in positions, but we adjust potentially every day. We need to adjust the positions. It doesn't take a lot of time to do that, but it doesn't mean we need to be present and know what we're doing daily. So for our clients specifically, they know that the max volatility is going to be 10, 15% on the portfolio. So we shouldn't see anything greater than that on the downside. And they just sit back and wait for the return. So we have an audit firm who monitors our performance, and they feed back to their clients every month.
Oh, wow, that's great.
Yes.
But one of the common questions throughout people in internet is about who are that investors who provide hedge funds with the money. As far as we know, it should be accredited investors, which have a lot of funds, and they need to prove that their mindset is enough to handle the hedge fund risks. And the hedge fund, with the pass of time, become like a privilege on the market, I would say.
Yes.
How people perceive it. So the point is how you find these investors. Who are they? It's like some close community, or what is this secret?
So with funds, we can only deal with accredited investors. We cannot deal with retail people. If you're retail, I would just say just go buy an ETF, S&P 500, and you're good. But if you want to jump into the hedge fund space, you need to be accredited. By that, you need to qualify with one of 3 key metrics. Either you've high net worth, so you've got a lot of money, or you've got experience in the field. And it's quite similar regardless of the country or jurisdiction you're in. So what we look to do is we go to institutions, we go to family offices, we go to VCs, venture capitalists, we go to CFOs, chief financial officers, we go to other funds as fund of funds. So we go to these big institutions who already know how the game works. And we then present our track record to them and say, this is what we've achieved in the last 6 years. Are you interested in diversifying your portfolio for us to manage some of the funds? And if they like what they see, they'll say yes. They'll have a few technical questions. They'll see our mandates, speak to our auditors, do their due diligence. And if they're happy, they then bring in the funds. So the best people to go to are the institutions. A family office, they've already got multi-millions under management, and they'll just allocate a very small portion to you. To us, it'll be big, 3, 5, 10 mil. But to them, it's just, 3% of their overall portfolio,
Mm.
which to allocate to you. So yeah, definitely VCs, family offices, CFOs, those big guys. And if you do have access to the wealthy guys, then yes, you can reach out some really wealthy individuals to invest in your fund.
How long it takes for you to prove that you are reliable? I mean, you told 6 years is the
Yes.
minimum, or we have no minimum?
The minimum I'll say is 2 years. If you've got a 2-year track record, you can then start approaching people as long as it's audited and verified.
I can assume that if I wanted to open a hedge fund, I have to have good strategy, trading strategy, show results during 2 or 3 years in a row, and then to collect my team, go to the institutional company and just present my strategy in order to attract investment. You just proceed going.
You need to get regulated in a jurisdiction. So what comes first, the chicken or the egg? Or do you open your company first and get a track record in your company name, which is what people will need to see? Or do you start building a track record before getting the company? So to get the actual hedge fund itself, you will need to go to the different jurisdictions, and it has a very healthy price tag on getting regulated, depending on where you are. If you're in the UAE, it costs you $150,000, for example, to get the company opened and the regulation. So it's expensive to get in. So you pay that money on day one. It will take about a year to go through, depending on the country and the jurisdiction. Will take about 6 months to 12 months to get your regulated license. When you do get that license, you've now paid $150,000. You now need to start raising capital. But you can't raise capital straight away because it's a brand new company. You're starting with zero. So now you need to trade for 1 year, maybe 2 years before you can start actively going out to get investments on board. In the meantime, you're going to have your ongoing costs of the fund. You need to have anti-money laundering officers, you need to have your audit team, you need to have your administrators, and some, depending on the jurisdiction, you need to have directors in that country. So you're probably talking about another $50,000 at least a year you'd be paying on top of that. So the overall cost is probably $200,000 to $300,000 before you actually start generating revenue. And that revenue only comes if you're able to successfully raise capital from someone. So it's a huge risk. But as a fund manager, that's what you do. You manage risk. You can go to other jurisdictions that are not so expensive. You can look to go to seed funds, startup funds in the Virgin Islands, perhaps BVI, British Virgin Islands. You could go to Cayman Islands. That will probably be about $60,000, $70,000 to get started. So it's still going to be a big cost, but it's a lot cheaper than going to Dubai, definitely cheaper than going to the USA and the UK. So you can start off with that to build a track record, or you can just get a company, open a trading account and build your track record. Yeah.
So it's kind of
with your personal fund. So that's what I did about 8 years ago. I just got my own company set up and traded under my company name. And then 2 years down the line, started approaching funds and say, right, this is what my company's done. And then you're able to open up a new company, but same name. And now that's a fund.
Yeah, it's a very smart approach. But do you have any limitations in case you're opening it? Of course, it depends on jurisdiction, as we discussed before. But do they do, like, you're trading, for example, up to 1 million, so up to 100?
For startup funds, it depends on the jurisdiction, but you're probably looking at 20 million for the lower end, and 100 million is going to be a very good startup. So usually, if you do like an accredited fund, it's going to be 100,000. It's going to be $100 million that you can trade. And you might have a limitation to the number of investors you can have, which might be 20, 40 investors, which you then put in the 100 million.
So when you started your own company 8 years ago, you attract investors who trust you. So that was the way how you generate the money to trade.
Yes. So when I first started about 8 years ago, what I did was I first built the track record under my company name. Then I approached a few VCs and funds, and one guy said, "Yeah, I like your track record. I'll test you out with $100,000." And so that's how we started, and it just moved on from there to where they started giving us a lot more money to manage for them. But yeah, it was just to build your company first to get the track record, and then look at the hedge fund infrastructure at a later date.
Oh, I got it. So it's a huge pressure. How you survived and under that pressure?
So we build systems for every environment and for all conditions. And so when it comes to the trading itself, execution, we're very calm, cool, collected under that. That's not an issue. We're used to every market condition because we've tested every market condition over and over and over. And you drill it like soldiers drill their walking and marching. And we drill it in us so that when these things happen, which it will happen, there will be another market crash. All these things are going to happen. So when it happens, we're already prepared for it. We know what to do, how to mitigate the portfolio. Plus, we're always actively putting on what we call black swan hedges. So we're always actively hedging against a market crash, market turmoil. And that's from an us perspective. But then from a market perspective, you have what you call circuit breakers in how we trade. So they will not allow the market to crash 50% in one day. They'll stop trading. So if the market goes below a certain percentage every day, it's called limit down. They'll actually pause trading for that day. And if it goes even further down for the week, they pause it. And it could be as much as a month, they'll pause trading until it settles again. So our systems are built for black swans. And we also know if the worst is to happen and limit down fails for whatever reason, which I doubt it ever will, because they just literally just stop trading. Like when 9/11 hit, they stopped trading. So when something like that happens, we, one, already have protection, and two, we know that the authorities will stop the markets from just going to zero.
True.
So we're safe. We're calm.
Relatively safe, as we can say. But it's really different from trading, from simple trading, day trader and the hedge funds. Hedge funds focusing, as I got from you, in leveraging the risks which you have, so you're prepared to any condition. But you're starting from a small amount of money, I would say like $10,000, $100,000, or you will recommend to start with the huge money, like with the big money from the very beginning, in order your plans to build the hedge fund.
You'll need to start small because it depends on how much capital you've got to begin with. But hopefully, by the time you get to the conversation of I want to run my own hedge fund, you've already proven to yourself that you can trade and you can survive when market turmoil happens. You know, when 2020 happens, when 2022 happens, how did you perform? So as long as you've got that confidence, then you can put in any number you want because you know that you're a master of risk. You can control the downside. That's what we do. And as long as you can control the downside and you are comfortable with that, you should be able to manage any number, 10 mil, 100 mil. It's okay because percentage wise, you're in control of what that downside looks like. So starting off, it will come down to, can you as an individual see big red numbers and how do you react when you see that? If you're losing 5,000 a day, would you have the same emotional feeling as when you're losing 500,000 a day? Would you panic at that point or not? So once you've got control of seeing these numbers and knowing that it's just a percentage and you're comfortable with that percentage, for example, if I'm down 0.5% on a day on a $1,000 account, I'm okay. Equally, if I'm down 0.5% on a $1 million account, I'm still okay. But the number is just, I'm losing $50,000 and it's still just 0.5%. So after a while, you get to think in terms of percentages and just be able to manage your risk that way. So in order to answer the question as to how much to get started with, I would say by the time you get to running a hedge fund, you should be comfortable. You should definitely be comfortable managing $1 million. So to start with $100,000 is not anything of your own capital to put into the fund just to get your track record going. That should be something you should be very comfortable doing.
Can you share your advices, like maybe your experience? And then I would say, let's do 3 major advices regarding the psychology of trading for traders who are not the beginners, but who are trading for a while, but still are not profitable. What was your main challenging while perception of risk, while looking at numbers and feeling nothing? How you achieve that goal?
So one, if you're not profitable, you have to identify why. Why are you not profitable? Is it you? Are you the problem? Or is your system the problem? So you will need to find a way of identifying what is the actual problem. Are you the problem? You're trading, or is your system the problem? So what I would do initially is I'll make the entry as mechanical as possible. Make the system as mechanical as possible. There is no one strategy you find out there which gets a direction that will work forever. That just won't happen. But you will need to be able to say, I have run this particular system for 100 trades, for 1,000 trades. and I have got the data. My execution has been perfect every single time. So the problem is not me. The problem is with the system. That's where you need to be able to get to, because then you can always change the system. If the problem is you and you think the market's going to do something and then you do something, you react, you get caught out every time because you can't repeat that process. You can't repeat that success. You need to be able to repeat your successes. And for me, when I started off, I had to make the entries of my strategy as mechanical as possible so that I could say, right, this system is not working. I'm doing everything perfect, but the system's not working. And you change the system and you bring in a new system. So then what I ended up doing to achieve profitability was built several systems for several market conditions. And in each one, you can need like a moving average crossover just for intraday in a trending market. That would work very, very well. The most basic strategy. But in a trending market, when it's really moving, perfect. Just use that. But when it's ranging, you might not want to use that because you get chopped out. You might not want to do a mini version trade as opposed to not. So I built a number of systems, and then my job as a trader was to find out what market condition are we in today and which system should I use. So then I had everything already there. I knew my execution was perfect. So there's not a me problem, there's a system problem. So then the only dynamic which then will make you a really profitable trader as opposed to not, it's just understanding what market condition you're in. And say, okay, we're in a trend and we're in a range and we're in a volatility or whatever it is, you've got a system for it. And sometimes just no system, like, well, this is just too crazy. I'll just wait and do nothing. So that would help you become a profitable trader once you've got these set of rules in place, which are repeatable. It must be repeatable because you're going to do this forever, right? So you must be able to repeat it over and over and over again. So that's the first thing for the actual trading itself. But the most important thing, which we always go on about, or I was going on about, is risk management. You must be able to control your risk. And that is asymmetric with your return. And what you find a lot of people want is lots of money very, very fast. They want the crazy numbers. And that also comes with the crazy risk. So the goal is to try and keep your losses as small as possible. Just keep that risk under management, because if I talk to an investor, I can always guarantee to a certain degree the maximum you will lose. I never guarantee your winners, but I can guarantee your losses. Because the one thing as a trader I control is the losses. So I make sure that I control that and I manage that properly and effectively. So once you've got a very good grasp on your losers, the best loser then wins. So when you're very, very good at losing trades, you will find the profit is a byproduct, is a side effect of good money management. And so you then just start seeing your portfolio growing slowly and surely. Then once you have all of that set and you're comfortable and you're profitable, you know your numbers. If you want, you can now start taking a risk to go for some home runs. You can try and get some big hitters, because you've done it for long enough. You know your numbers. You know what things look like. Example: if I'm right 7 out of 10 times in my trades, okay, well I know I'm definitely going to lose 3 trades. So maybe after I've lost 2, I might take a big swing for a home run and hit that. I think, oh, that's a nice month, And so we do that on what we call our spec accounts, our speculation accounts. So for our main accounts, we don't take any crazy risks. But for the speculation accounts where we just want to feel a bit more emotion, we do that kind of stuff just to have a bit of fun.
To have some adrenaline and all that stuff.
Exactly.
Whoa, that's very cool. But we were talking about the market conditions. They're really different and they always changing. I think that is the most great advice that we can do is just we need to control risks. We need to adapt fast.
Yes.
And we need to follow discipline, follow our rules.
Definitely.
Could you tell in short, like approximately how many strategies you have?
I've built over 200,000 systems.
200,000?
Yeah. And this is why I come from a place of confidence when I say there is no one strategy that works indefinitely. Because one thing which we did was for Forex, which is where I currently trade for a hedge fund, and my mandate is to trade Forex for them. So I trade Forex for them. And I built a load of strategies back in the day. Every day I'm building 2, 3, 4, 5 strategies. We've got some data mining software. We mine the best algorithms for a data set, and then we go live with it. So we just built so many algorithms. You name it, we built it. And it's very difficult to find one system that works forever. So, I mean, when I see people have successes in trading, I'm always happy for you, but I'm hoping it's not short-lived, because it could just be a period of time that system was working before it stops. We call it alpha decay, because your alpha is what makes you a good trader, and it decays, it goes away. So alpha decay happens to pretty much all strategies because the market is efficient. It's very efficient.
The idea that you shouldn't be able to buy an asset and sell it immediately for a profit is known as the efficient market hypothesis.
The more people try to make money by predicting the stock market and then trading on those predictions, the less predictable those prices are. If you and I could predict the stock market tomorrow, then we would do it. We would start trading today on stocks that we thought were going to go up tomorrow. Well, if we did that, then instead of going up tomorrow, they would go up now as we bought more and more of the stock. So the very act of predicting actually affects the quality of the future outcomes. And so in a totally efficient market, the prices tomorrow can't possibly have any predictive power. If they did, we would have taken advantage of it today.
And if you've got something that works at 9 o'clock every day, you buy, 9 o'clock every day, you buy, you make money. After 3 months, it's not going to work anymore, because the market would know that. The market learns that. It says, okay, we're going to make money from the opposite side of the trade. And you see the market just changes. So alpha decay is very real. I've built a lot of systems, a lot of strategies, and I know it to be a very, very difficult road that people are going to go on. Mm. There are ways in which you can do well, which we do, but you need to look more at data science from our perspective, data science, and actually looking at probability on success and almost becoming a casino as opposed to the trader or the punter. So you know the odds of success when you take a trade is less than 50-50, even if it's a 1-to-1. So it's how do you flip that in your favor slightly? Mm-hmm. You know, do you go inverse risk reward? So normally you lose $1, win $2. Do you maybe lose $1, win $0.50? Because you win more, you'd hit the profit target more. But how would you feel when you have that big loss, which will come in? So you work these numbers out. You get these numbers, you have it all down. And once I've got the data in front of me, you're able to make informed decisions on the next trade. But yeah, I've definitely built a lot of strategies.
Amazing, like it's many. I thought about 10 or 15, not that amount. Oh, sorry. Okay, but you also have a IT background team in order to develop these strategies to be automated, like bots.
Yes.
And if you are talking about nowadays hype about the AI, can you share the secrets if hedge funds, especially your hedge fund, is using AI technologies in trading? And what do you think about the whole market? As we know that bots will react much more faster than people. And of course, 90% of all markets are institutions. So that will be a competition of machines, how to earn. And there would be no sense in trading manually, or how you see the future of the market.
So you have different market participants, and everyone stays in their own lane. So there'll be the market makers who are making money in between spreads. So they need ultra HFT machines next to the exchanges to try and just generate a little bit from that. So you have those guys. Then have the HFT traders who try and front load and back load your orders. So as you're putting an order in, they jump in, they make a little scratch off the back of it. So you have those guys. You don't have just your standard algorithms, your bots that go in and out. You then have your mathematical algorithms that look for discrepancies. You then have your arbitrage systems that look for one exchange versus another exchange. So you've got lots of different ways of doing things. But you also got the manual way of doing it. So manual is not going to be obsolete, but we're not competing with the arbitrage guys. We're not competing with the HFT guys because we'll lose. We don't have that kind of capital to compete with them. So when our trades are placed at a price, we see a price and yeah, it gets executed and we're happy. That's good for us. But before it gets to the exchange, there's a lot of people trying to get in there, front load and back load it, because you've been quoted a price, but there was latency. So it took you a while. Think of it like old school back in the day when you had athletics and there's a gun. Nobody uses the guns anymore. because by the time it gets to the person in lane 8, they fire the gun here. By the time the sound travels to this person's already reacted. So you have person 1, 2, 3, 4, 5. The gun goes off here. This person hears it first before sound travels here. So that's why they stopped using the gun. But that's what happens with us in trading. We're over here. So by the time we get the price, it's gone through, or other people get to see it before we get the price. So the price we see might not be the actual real price. You know, we might think it's 101, but it's actually at 100. We're seeing 101, but they've got it at 100 before we even click the button. So it's a different game. We just play the 101 game. So we just click it and it's cool. They might make their bit. That's not our concern. They're fighting other big institutions. You do your thing. With us, manual traders, yes, we'll get probably the worst price, but that's okay because we're just used to that. That's all we can see. We execute our trades and we just wait for our profit targets to hit. That's why I don't recommend scalping or anything like that, because for us to scalp, we just don't have the technology to do it as effectively as the big players. So yeah, if you're swing trading, position trading, I think you can still have success manually trading or with your own algorithms. If you're day trading, it's going to be very, very difficult or really difficult. It's as random as you can imagine it to be. So day trading will be very difficult, and anything smaller than that will be really difficult. So yeah, just good luck with that if that's your journey.
True.
Yeah.
But what do you think about a lot of people right now are focusing on developing some special bots who with the AI who can trade perfectly and change and adapt to the market conditions? Do you believe in that, or it's one more hype that people trying to do marketing stuff?
Marketing, yeah, because you have to look at the market as a living, breathing organism. The market is me and you. We're traders in the market, right? AI is good. It's going to be good to help develop systems. It's going to be good to help analyze systems. It's going to bring objectivity to your approach to the market. But AI cannot beat the market because for every winner, there's a loser. So if you have AI and I have AI, who's going to win? We're both not going to make money. So the idea of that being the holy grail is incorrect. It just won't, because we're all going to be using AI, and then whose AI is better. So it'll come down to the basics of supply and demand of the actual goods. That's all it comes down to. Also, one thing I would say is if I was a multi-billionaire and you have your AI, how do you know this second that I'm not just going to decide to buy all the shares and drive the price right up?
True.
You don't. So it's that's how I think of it. So I always think of it as I never know what's going to happen. And nor with an AI, what it can tell you is based on history, this happened. So you might be able to get some probabilities and jump in on that. But for it to beat the market consistently, I don't think it will happen. It's definitely good for analysis. You can look at it and say, oh, okay, so this happened, and it'll give you a really good opinion, good for fundamentals. You say, okay, so this news story I can interpret it like this and like that. But ultimately, logically, perform well consistently just because someone else will have AI too.
I say that fundamental analysis is more retrospective analysis, and it's not working on the markets.
Yeah.
Yeah. Oh my gosh. But what do you think about insider information? Is that a myth that there are some companies who are also hedge funds and mutual funds? They're just speculating with some insider info from some companies. They're going to launch something, and you're trying to put the position just in order. It will happen.
So insider definitely happens. It happens all the time. Yeah, that's just the nature of the beast. If you look at the US politicians, they're all insider trading. They're the people who beat the market all the time because they know they're about to approve something in Congress, and so they know it's going to skyrocket, and then all of a sudden they're buying millions of dollars worth of calls on it. As in, they're the best traders that have ever existed, and they run the law. Equally, people who work in mergers and acquisitions, corporate finance, they know when a company's going to buy another company, and you'll whisper to a friend, get that stock, then it triples in 2 days kind of thing. So yeah, insider stuff definitely happens. Again, it's not our lane, but if we had a way in, that would be brilliant. But yeah, they've just got a lot of knowledge. Plus, aside from that, a step aside from the insider stuff. So insider stuff is just blatantly illegal, but they do it. But then you also have companies who have access to government satellites and to surveillance stuff. And if you're working in, let's use Amazon for example, if the Amazon warehouses don't have any trucks going in, they're going to say, well, no one's buying from Amazon, so they're going to start shorting the stock. But if they see loads of trucks now coming to the Amazon warehouses, they think, oh, people are buying. And before anyone knows, they can see the surveillance, they can see what's happening, and they then start accumulating positions. So that's the next level up, where they've got access to these things that people just like us just would never have access to.
Might be they have some special position, like special people who are, I would say, investigators of the markets, like what is going there. They're analyzing. I also know some tricks with the shipping and all that stuff. You think that there are some particular people who are doing it all the time, or it's just like you should be in some circle in order to get known?
You need to be in a circle to do it, because there are people who do it, people who have influence, who have powers, and they have the power to change the law, but they just won't do it because they're making money. Right, so
who wants to share that?
Exactly. So they just won't do it. So yeah, we just stick to our lane, what we have access to, and try and make money in that. But yeah, they're killing it.
All right. But back to the government, as far as I know, in some jurisdictions, hedge funds have a limitation of the profit that you can give to your clients. Is that true?
Hedge funds, depending on how you set it up. So when you set up your fund, you will put in your fund mandate, and you say what you're going to deliver. So we're going to do this, and sometimes you would have a fixed return of 15% or 20%, and that's the maximum you'll be able to deliver. The government won't stop you from giving 100%, for example. It's unlikely per year, but they won't say you can't do it per se. But it's just the jurisdiction you get your structure under. When you set it up, you would put in whatever limitations you want on the fund at that point. But it won't be, the US government say you can't give your clients 50% per year, because you can. That's the whole point is greed. We sell greed, and we say, well, I can make you more money. And the next hedge funds, well, I can make you more money and even safer. So that's just what we do.
So, is it true that hedge funds can have some particular problems with the government or people who are not interested in competition? They just try, if they see that hedge funds bring a lot of returns, so people will bring money there, not to their, for example, other mutual fund or some family office or whatever. So the government and people in the market trying to make all things for hedge fund not to be allowed to earn more than 50%, I would say, from depot or something.
So the government are trying to restrict the earnings of a fund?
Exactly, like that you should reduce your positions. For example, if you see a huge returns, you're just like, okay, I can't afford it because of rules.
Yeah, I've not come across that per se. I've come across it where it's to do with the exchanges would be able to limit your positions based on leverage and margin, because they give you, if you buy 100 shares, they give you the purchasing power of 200 shares, for example. So the exchanges can limit that for you. But if you own 1,000 shares of Apple and Apple just keeps skyrocketing, they wouldn't be in a position to force you to sell those shares because you're making too much money. It's like, well, you just got a good home run. That's it. But I've not come across the government themselves jumping in to intervene, say, hey, you guys are making too much money, stop. Because that would kill the business. Because we're in the business of making as much money as possible. Most hedge funds don't. Most hedge funds don't actually beat the market, but hedge funds provide a different take on the market. So you might not just want to make as much capital as possible. You might want to preserve it. You might want something alternative to bonds, which would still beat the bond market, for example. So we have lots of different ways of doing it. But for governments to come in and say, hey, you're making too much money, I'm not seeing that. They might say you're charging too much fees. But again, if you're delivering to your clients, you can charge as much as you want. So yeah, that's not something that I've come across from a government perspective.
Okay, so we have a hope for like natural competition.
Oh yeah. Yeah, natural competition. What the SEC or something will do is they'll try and prevent someone from cheating. Yeah, so they'll try and stop the insider trading. They'll try and stop the insider information. That's what they try to do. Do you have any advantage over your competition? Because we want to keep it to be a free and fair marketplace. That's what they hope for.
Mhm.
Although they're the ones actually cheating themselves, but let's not get into that.
Yeah, but sometimes they went very crazy. Like if we are talking of what SEC doing sometimes, we just like, come on, like
Yes.
it's too much.
Yes.
Please
Stop.
One of the most popular question is how to become a manager or trader in a hedge fund. Is that real? So in that like simple guy who is trading good for 2 years, I would say, yeah, he is not losing money and he control his risks and he wanna work with you. He showed you all results. Would you take him into your company? Like, of course, for some probation period, I think.
Yeah.
How it's going on.
Yeah, so it typically depends on what they're trading because I have a mandate. For example, if we're a Forex fund, we can only trade Forex. And if someone comes and says, well, I trade equities, I've got a good record, we can't take you on board because we're only trading Forex. If we're multi-asseted, then yes, possibly. But typically, they'll need to go through some kind of, for the big guys anyway, for the big guys, you have to go through some kind of internship to a junior role, analyst role. Then they'll give you a seat on the desk with a small bit to manage with someone overseeing your risk and stuff. And then you can progress there to managing the larger funds. That's the institutional route. But from the ad hoc route, from the small emergent funds route like us, it's more just as long as you've got a good track record and we can see it and we give you access to a platform to trade and you deliver, we just monitor the risk on it. If it ticks all the boxes, we then start allocating capital to you. And as time goes on, you end up with a lot more capital. And yeah, you get your bonuses and stuff at the end of the day, yeah.
So you're open for other traders?
Oh, definitely. Because one thing which you can't have is a single point of failure in any business. And because I'm the primary trader here, if I jump on a bike and crash tomorrow, it's going to be very difficult. Someone's going to take over what I'm doing. So one thing which we're actively going to be doing, not now, but it's going to start in about 12 months' time, is we're going to actively be training and getting traders up to speed so that we have a trading desk. It's not just a guy trading a lot of money. It's a full desk. So we're building an enterprise where we are able to bring on lots of people and they'll need to have the same kind of mindset that we have to execute the same way we do. So I'm going to go through a full training program for them, 12 weeks initiation and then 12 months, 24 months, and then we give them capital to trade with.
That's a great opportunity. It's kind of the probation prop firm.
It's not prop. We don't do props. It'll be live capital.
Oh.
Yeah, but prior to you going live capital, we'll give you something like $10,000. So nothing crazy that we can't recover if you lose it all. But after you've gone through the training, you should be in a position to execute properly without losing it. So I'll be very surprised if someone did.
But you're going to teach them from the scratch, or?
Yes. So it's going to be, we will run a program which would get you from interested to being very good.
Oh my gosh.
Yeah.
Can you share with us like whom guys should follow in case like to be prepared to your training stuff?
Yeah, so there's a guy who I'm working with. He's in Dubai. He goes by the handle Wannabe Champ, Dan, and he's a prop firm kind of guy. And he's looking to move into the institutional space. I said, look, well, I've got a hedge fund. If you have traders who are good, we can get a multi-asset license because they do CFDs and FX. And I said, if your guys are good, we can do that. But ideally, I know I've been delivering results for the last 10, 12 years consistently. So I'd like people to be on the kind of stuff that I do. So let's create a full-blown academy where we can bring people on and eventually we can just focus on acquiring capital for the business and using systems as the flagship system and other people trade it so that we can just go bringing in more money. Then we have traders in there. We don't have a single point of failure. So yeah, Dan want to be champ. He's the guy who said, no problem, I'll make it happen.
Oh, magic. Okay. So you have like where traders can follow up you in a LinkedIn account, or there would be any announcement, or it will be like a private thing?
It will start off private. Because I want to make sure that I can work with people, because you're going to be working with me every single day. And it's a lot of effort from our side to do, because our trading itself we don't spend that long actually physically trading, but to teach will take you a while to get up to speed. So we're going to use a lot of our time to do it. So we're going to work out how we can do it, whether it's going to be a classroom-based course where you, like a job, you come 9 to 5 and we're on the markets all day, every day. A bit of theory, a bit of practical, a bit of theory, but just running through it. And then some mindset stuff, just go through the full process, give a 12-week crash course, and then we do evening sessions after that. Just make sure you maintain it, then give you a small bit of capital, and then we go start increasing it, so that people perform, we get more money, and so on and so forth. Yeah. So once we've got that, you got the flagship, you know exactly what to do, because you have the way we do things, then it'll be right. Now you go experiment and build your own and see what we can do, because I know you got the foundations now. So you can, okay, I like how Black Swan hedge, but instead of using 20 days, if I use 16 days, the IV spike moves a little bit low. So you can come up with different concepts. I think, well, yeah, this works better for me. Man. Do it. The only thing we care about, one, is not losing our clients' money, and two, not losing our clients' money, and three, generating them some return. And so we've got, as I said, we've got very good systems that can achieve that.
Numbers talk.
Exactly.
But you also can we find you're in social media? You are going to be, I would say, public, or you're trying to keep your stuff more secure and private?
Yeah. So at the moment, I'm on Instagram, and I've just started a TikTok. Not trading related. I don't talk about trading at all. The only time you see anything posted on the market would be on LinkedIn, where I just do a summary of popular news articles and give it my take. That's the only place you see anything remotely related to the markets. But certainly Instagram, TikTok, I don't put anything in trading related, just because it's not the audience that I'm going for. And when our fund does get large, I say large, 50 mil is not large in the hedge fund world, but once we get there, then my socials be coming down, everything but LinkedIn. Yeah.
I think I got what there is.
Yeah.
Okay.
So the lifestyle can't be out there, because one thing that everyone would ask for the big players is, who's the fund manager? Who's looking after my money? And what you don't want to do is give them opinions. You need to be as grey as possible, in my opinion. So you don't want them to think, oh, I like this guy. He looks really, or I don't want them to be able to form an opinion based on something they see online. So once we get to the stage where we're approaching the big players, then my socials will be pretty much gone.
Okay, I got it. So this video have a duration, right? It will text me like 1 year.
I think we have about 2 years to get to that level that I need to. We have a plan on our board just around the corner on how to get to 100 mil. So everything is in motion as we speak. Yeah.
Okay. So just text me like, Maria, we should delete it, and I will be happy for you.
This is good. It can stay online. This is my personal accounts. So I wouldn't give anyone any reason to like me or to not. It's just my result. That's the only thing.
So you always knew that in the future you will be at the points that you are now.
Correct.
You had a vision from the very beginning.
Yes.
But you start to act with a plan, or you just had approximate vision and you were investigating what's on the market, or you might be had some advisor who shared with you some information, and it was much more easier than doing it alone. How it was.
I did it alone, but I was just motivated. So everything you see here, what we've achieved was all in here as a delusion to begin with. So I was deluded. I'm going to have a house with a pool and this. It just didn't make sense. I didn't know how I was going to achieve that, but I knew it would be done. And so everything was in my mind as clear as day. And what you find is once you're obsessing over it, in my experience, once you obsess over it, you kind of just gravitate towards the people who can assist that journey and who you can help with their journeys. And that's what happened. I wanted to trade, and a friend of mine said, "Oh, I work for this company." I was like, "Really? What's it? Yeah, what you do?" Like, "Oh, you need to open a broker account." I was like, "Oh, great. Show me." So open a broker, and then the next person. So it just took me on a journey. I just got obsessed with it. Don't sleep. Just learning. Fading lots. Then when I learned how to lose properly, then the profits started coming in. I said, "Right, I want to run a hedge fund." I said, "Okay, I'll do it one day." And then, just the cost to start up a hedge fund, it was so much. I didn't have enough at the time. It was just a pipe dream. I didn't have enough to be able to do it. But now, so many years later, I'm able to afford to get the regulation, get set up, get all the compliance done, etc. So we're able to launch our own hedge fund now. So now the next target is what you see on the board. And that's going to be within the next 3 to 5 years, we're looking to hit that. So I'll be very, very active.
And do you remember that first moment that you got involved in the trading? Like, how did you learn about the financial markets? I do remember myself.
Mhm.
I was started from very simple, from the scratch, like with the reading book of Robert Kiyosaki, of course.
Of course, that's where it starts.
And then I just saw one guy. I was a business analytic in one fintech company, and he was trading, but he was trading crypto. And I saw the charts, and it seemed like I saw that in the movie. And I'm just like, "Can you show me what you're doing?" And he just like, yeah, we have like a market here. This is the price, how it's going. If you see the red candle, that means the market going down. The price here, you can open order, trading with leverage. So that's it. Like, it was 40 minutes. And then I start to drill, to get okay, what is going on? And then Bill Williams and all quantum trading.
Yeah.
Blah blah blah, and you're sitting on the computer like 70 hours in a row just trading. Oh my god, that was amazing. So what was your moment? How you get to know about trading, and how you felt like this is what I want to do?
Yeah, so I started off by looking at what rich people do. I was studying the rich, and they're all invested in stocks and shares, or they had property portfolios. Then I looked at the two of them and thought, which one can I do? Property made more sense because, well, you think you know it. So I thought I knew, but I didn't have enough money to get started in property. So now I was looking at trading and trying to research. And back then, there wasn't a lot online. I was trying to research, but I found somewhere that said, "Oh, you can open a brokerage account and have $200 in it." I thought, okay, cool. What's a brokerage account? So I couldn't find one. I couldn't find the right words to even search to be able to open a broker. And a friend of mine came and helped me out with that, and he's opened up a City Index account for me. And then I deposited £50 in it, and I made 200 or 400 pounds off the back of that trade. Not knowing what I was doing, just bought in the morning, and it shot up.
Oh, lucky you.
I know. So after that, then I thought, right, great, and this works. But I kept losing after that. So I took out the money, I spent it. It was real, but I felt like a computer game. On your phone, okay. But then I just kept losing. So then I thought, let me get some education. So again, I looked online to try and find some education. There wasn't much out there back then. I found a course on moving averages, crossovers. So I bought it. I didn't know what it was, but I bought the course. Great. But that got me into thinking of systems. It kind of helped the journey because the strategy was when it crosses, you buy. When it crosses up, you buy. When it crosses down, you close. So very simple. And I thought, well, if it's that, can't it just be coded? And back then, I didn't have all these codes and stuff. I didn't have access to it. So I went looking for charting platforms that offered at least alerts. And I found one. So when it crossed, I had an alert. I was like, great, I'll buy now. I'll buy. And it just wasn't working. I kept losing. I thought, is there a way I can test it to see would it really work? So then I went on to trying to find a charting platform that I can use to test, which I found Pro Real Time. And I thought, ooh, it doesn't work. So then, yeah, it was, I said, okay, cool. Then I went to look for other courses, and I started buying courses from that moment onwards, 2010. I was just buying a course pretty much every second month, just someone online. And most back then it was DVDs. You didn't really have all the online stuff, so I was buying the discs.
Yeah, we should keep in mind that it was a long time ago. There were no such technologies right now. Like, we can choose.
Exactly. Now there's so much information out there and lots of good stuff for free. Like then there wasn't YouTube. It just didn't exist. So I just kept buying different courses, learning different things, and just kept going because I knew I'd made money before and I knew money could be made. I just thought this is my only way out. And the second I get it, the second I know how to trade properly, because I didn't have a lot of money, I'll then use other people's money to generate more profits for me. And so that's what happened. And once I got good at it and I got consistent, I then went to friends and family, started trading their capital, making a small percentage for myself, which increased my income. And then
confidence, I think, as well.
Yes, definitely. Managing other people's emotions is quite tough. So when you first start,
I can't imagine even.
Yeah.
I've had such an experience, but yeah, that was challenging. And you have to have a system which controls your contract. By that, I mean that we had an agreement about trading someone's fund in crypto. And that was a hype in 2023. And it's appeared that on the hype, I decided, okay, I think it's overheated a lot. So we have to cut the position or reduce some of them. And at that moment, we earned 30% from deposit for 1 month, which is very good. We were trading only spot markets. But then, like, I suddenly opened the account and I saw a lot of shit coins, and I didn't make this orders. So I am calling to my client and just telling, like, hey, don't you know what's going on with the account? And he just like, oh yeah, I feel that the market will go up. I have inner feeling.
Yeah.
And I'm just like, no way, maybe you have some arguments, maybe you have some inside information or something. He just like, no, it's my gut feeling. And just like, are you sure? And yeah, he was like, let's hold it for 1 week. In 3 weeks, of course, we lose 40% from the account. And then he decided, okay, let's close it. But Maria, you should help me how to get my money back. And I'm just like, oh my God, we had to make an agreement before. It was my lesson. But then I returned only 28% from that using futures.
Okay.
I just short it because crypto, of course, if it's hyper huge, and of course we're going down very fast. That was a safe part. But yeah, we were talking about, sorry, it was so emotional from my side.
Yeah, because you have to manage their emotions, and that has a big impact on you because you have your emotions to manage, going up and down, and then you have now theirs.
But you have a contract with them, and they have no access to the funds.
Yes, so they don't have any access with me. They gave me the funds, and we traded it for them. So that's one way. But you can run it as a PAM system, depending on the broker you use, where it's a pooled fund. So you trade a master account, and all your clients, their money's pooled together in one account that you trade. So they can do whatever they want, but as in taking it in and out, but they can't physically trade. I've never had it where a client can execute a trade. That's just too scary for me.
I understand what you mean. So the conclusion of that, I could say we can prove that it's possible to earn on trading. Trading is not a casino. Mathematically, you can achieve results here. You just need to proceed going, building systems, being disciplined, and
yeah, I'll say trading is a casino, but it's your choice whether you're the house or whether you're the person coming into play. So you want to be the house. The house has no emotion, probabilities, and it just plays. So every time someone comes in and they win big on blackjack and they make $1,000 and they've won a lot of money, the casino won't say, okay, we're not playing to 21 anymore. We're going to do it 23 because you got to. They just stick to the system. They stick to the rules, and they let the law of large numbers and the law of probabilities work in their favor. And that's what we need to do as traders. If we have a system, we say, what is the system going to return after 1,000 trades, after 10,000 trades? Has it got a positive edge? The answer is yes, you can use it. The answer is no, don't. So be the casino.
Oh, amazing. Thank you so much. Thank you.
You're welcome. You're welcome. Thank you.
That was
Appreciate it.
amazing and very insightful for me, actually.